If you've ever searched how to invest in ETFs and followed one of those guides, there's a real chance you did something wrong and didn't even know it. Not because you're careless, but because almost every guide online is made for Americans. And what works perfectly in the US, in Europe? It can be blocked, inefficient, or just straight up not allowed. I've been investing in European markets for years now, and I keep seeing the same mistakes over and over again. People buy the wrong ETFs, they pick the wrong broker, they ignore taxes, and most don't even understand what they're buying. So in this video, I'm fixing all of that. By the end, you'll know exactly what to buy, where to buy it, how to structure it properly for your country, and how to set it up so it runs automatically every month. No confusion, no guesswork. Let's start with the thing that confuses almost everyone. Here's what usually happens. You watch a video and they say, just buy VO or just buy SPY. Sounds simple, right? So you open your broker, search for it, and it's not there. Or worse, it shows up, but you can't buy it. And you think, is my broker broken? No, this is European regulation. As a retail investor in Europe, you're not allowed to buy most US domiciled ETFs, not because they're bad, but because they don't meet EU disclosure rules. So the system blocks you. That's why in Europe, we use something different. UCITS ETFs. Think of UCITS as a European standard, a rule book that every ETF must follow. It forces funds to be transparent, it limits risk, and it protects your money. And honestly, in many ways, it's actually better for investors. Now here's the good part. Even though you can't buy US ETF, there's almost always a European version of them. You can't buy VOO, but you can buy an ETF that tracks the same thing, same exposure, same idea, just built for Europe. Now the next question becomes, what should you actually buy? Because there are thousands of ETFs in Europe, and that's where people get overwhelmed. So let me simplify it. For most people, you don't need 10 ETFs. You don't need 5. You can literally build a solid portfolio with just a global ETF, one fund that already contains thousands of companies worldwide, the US, Europe, Asia, emerging markets, everything. You're instantly diversified, no stress, no overthinking. If you want something simpler, cheaper, and cleaner, you can go for developed markets only. And if you specifically want US exposure, there are low-cost options for that too. But here's something almost no one talks about. Where your ETF is based matters a lot. 2 identical ETFs can perform differently over time, just because of tax treaties. For example, an Ireland-based ETF can lose less money to US dividend taxes compared to one based elsewhere. And over 10, 20, 30 years, that difference compounds quietly but powerfully. Now let's talk about a decision that looks small but changes everything. When you search for an ETF, you'll often see 2 versions. One says AC, the other says DIST. Most people ignore this. You shouldn't, because this decides how your money grows. An accumulating ETF automatically reinvests dividends for you. You don't see the cash, it just keeps growing inside the fund. A distributing ETF, it pays you cash regularly. Sounds nice, but here's the catch. In many European countries, the moment you receive that dividend, you pay tax, even if you reinvest it. So your compounding slows down. That's why most long-term investors in Europe prefer accumulating ETFs. Less friction, less tax drag, more growth. But, and this is important, it depends on your country. Each one has its own rules. So always check your local tax system. Now let's talk about brokers, because this is where people either save money or lose it quietly. The truth is, most European brokers are safe. They're regulated. Your funds are protected. So the real question isn't safety, it's cost, access, and usability. Some platforms are better for beginners, some are better if you want automation, some are better if you want full control and global access. But there's one hidden cost almost nobody pays attention to, Currency conversion. If you're buying ETFs in a different currency, that small fee, it adds up. Over time, it can cost you more than trading fees, so always check that. Now here's the part that actually makes the biggest difference long term. Not the ETF, not the broker, but the account you use. Because in Europe, many countries give you tax advantages, if you invest the right way. Some accounts let your investments grow tax-free. Some delay taxes, some reduce them. And if you ignore this, you could be giving away 20–30% of your returns to taxes unnecessarily. So the rule is simple. Before you invest, find out what tax advantages exist in your country. Use them first, always. All right, let's make this practical. If you want to start today, here's exactly what to do. First, understand your country's tax setup. Second, pick a broker that fits your style. Third, open your account. It's quick. Fourth, deposit money. Fifth, and this is important, search for your ETF using its ISIN, not the name. Names can change, tickers vary. ISIN is universal. And finally, set up a monthly investment. Automate it, even if it's a small amount. $50, hundreds. What matters is consistency, because investing isn't about one big decision. It's about repeating a simple action for years. Before we wrap up, 4 mistakes to avoid. First, buying too many ETFs. More doesn't mean better, usually just means overlap. Second, chasing performance. What went up last year won't necessarily go up next year. Third, panic selling. Markets go down, that's normal. Selling during fear is how people lose money. And fourth, ignoring details like fund size and structure. Small funds can shut down, poor structure can cost you. Pay attention. That's it, this is the full picture. European investing. Simplified. It's not complicated, it only feels complicated because most of what you see online was never made for you. Now it is. If you're going to take one action after this, make it simple. Start. Even small. Because time in the market will always beat trying to time it. And if you made it this far, you're already ahead of most people. If this helped you even a little, consider subscribing. It really supports the channel and helps me keep making content like this.